Well, thank you, Jonathan, for inviting me. I can't say it's a pleasure to be here because we're doing this obviously virtually, but it's very nice to be able to present this work, which we have been, this is a joint project with Sebastian Horn and Christoph Trebesch, and we have been working on this project for quite some time, uh, because it involves, as you will see, a very large data set that's taken longer than anticipated, but we are now at a point where we're ready to submit to a journal and so on. So give me about, the first 10, 15 minutes just to warm up. And then after that, questions, clarifications, and we can feel free to interrupt me. So the theme of our work has to do with filling in this big gap. For many years, the literature on private capital flows has grown enormously. Typically there's, the literature focuses on things like push or pull factors, external factors, drivers of private flows. Is it domestic factors, financial stability, impacts of the flows, and so on. But the point being, it's a huge literature. It's well represented in the financial press. The credit rating agencies all the time track, private flows, meaning if a sovereign issues a bond or takes a loan from the private sector, be it a commercial bank or bondholders, the credit ratings are on top of it. However, when it comes to official lending, meaning bilateral lending, government to government, or multilaterals to governments, or central bank to central bank, there isn't really a unified literature. Is very, very spotty. And what literature there is, it's broken up into little pieces, into little silos. Okay, so there's a couple of papers, including work that this very same team has done on central bank swap lines. There is a larger body of work on IMF programs, but more on trying to assess whether the programs were successful rather than connect to the literature on private flows. So what is there in terms of literature is very scattered. What we aim to do in this paper is to provide the big picture. Here's a 235-year-old, 35-year long history of official lending, whether it's bilateral government lending to help finance wars, or lending during, a financial crisis like the 1907 crisis from one central bank to the other, or in the post-World War II era, development lending, and also reconstruction. So that's where we are. What I'd like to do next is bring forward, we will go to this in, of course, greater detail, but I'd like to bring forward a couple of the big findings. There's some findings that I will present, and you will say, okay, that sounds right. I mean, it fits into our priors and so on. But there are some findings that are worth highlighting because they're not exactly along the lines of, what I think we were expecting, or more general is expected, and which is how big official lending has been, and is. Um, so, official lending, we think, oh, we're in the modern era, the capital accounts are open, portfolio flows are huge, interbank lending, and so on. So that it's private lending is huge, which it is, and official is sort of a second-rate player, but that's actually not right. Official lending is true that in peace times, uh, and in periods of no crisis, official lending takes a back seat to private lending. But when there's a war, when there's a crisis, official lending is the big driver. The most extreme cases, as you will see, were the two world wars, where private lending collapsed. Not a surprise. One of the things you see in the onset of the two major wars were widespread capital controls. Everybody puts on capital controls, private cross-border lending activity stops altogether, and the whole 9 yards is what official lending there is. Now, shift gears to the modern era. We're not certainly in World War I or World War II, but we do have wars. And again, what we highlight in this paper is that in wartime, as private flows tend to recede, official lending picks up. And be it peace or war, be it crisis or no crisis, for low-income countries, official lending is the dominant source of financing, cross-border financing. So if I haven't made it terribly clear by now, it's big. And this is, the profile, the 235-year profile of official lending. Our data starts in 1790, and you will hear, the details of what that data is exactly. But let me just say that what I'm doing here is sort of a preview of the big results. Another result is, how does it compare to private lending? I've already talked about the size and the scale of official lending vis-a-vis private lending, and how important it is during different points in time in our very long sample. However, what I'd like to highlight here is the cyclical dynamic, or, in very old work that I did, and many others have also worked since then in this area. Graciela Kaminsky, Carlos Vea, and I did a paper called "When It Rains, It Pours," and it basically is about the pro-cyclicality of I don't know how that changed, of the procyclicality of private flows. In good times, private markets want to lend to you. In bad times, the appetite from the rest of the world diminishes on the private side. So private lending and the work of Mendoza and Terrones and a number of other notable works by Uribe, Martin Uribe, and so on, it's pro-cyclical. Very different picture emerges when we compare the dynamic of official and private lending. Official lending is clearly counter-cyclical. There is obviously on the domestic side, we don't have a literature on this, as I noted earlier, on the international side, but, in the domestic side, there is the question of, is government borrowing a source of crowding out? What we find at the global level, at the cross-border level, it is not crowding out flows, meaning when the official sector comes in, whether it's a multilateral, the bilaterals, or all of the above, it is when the private sector has pulled out. So the private sector doesn't pull out because the officials come in. It is not crowding out. It is filling in a gap. So official lending is strongly countercyclical. Let me say, however, the however is in our work, you will see we not only have this very significant database on flows, we also put together a second database on stocks. And if I forget, someone remind me, please, to go back and talk about the impacts of borrowing a lot from the official sector when we talk about stocks in connection with the issue of crowding out. The other point that, besides being a stabilizing force, the other point about official lending is that its terms, when you compare we also collect data, as I will highlight later. Remember, in my first 15 minutes, I'm doing a preview of what I think are two of the big takeaways from this work. Official lending is on much more favorable terms than private lending, meaning maturities are longer, interest rates are lower, and official lending is not connected to risk the way that private lending is, meaning a higher risk borrower, a higher risk government, a government with a lower credit rating, a government with higher odds of default doesn't get worse terms. So these are, I think, some of the most striking of the findings, and that's it for sort of the high. So let's start from the top now in terms of, making sure that the concepts are clear, discussing the data we put together and going through the granular analysis that supports the two, broad conclusions that I have just discussed. So the takeaway on the comparison of official and private is, if you look on the issue of size, of how large it is, if you do unweighted, just average across countries, official debt stocks are 60% of external debt is to official creditors, is government to government or government to multilateral. If you do GDP weighted, because advanced economies don't rely as much now as they once did on official finance, it is 29%. So very substantive, whichever way you slice it. But in terms of the incidence of countries where official debt is dominant, it's the unweighted, it's more than half. The recap of what I've just said is the rest of this table, in which it highlights that also in their horse race between official and private terms of lending, official finance is more friendly to the debtor country, meaning lower interest rates, longer maturities. And importantly, and we will get to this, we ultimately, the counter-cyclicality of official lending is evident during any broad definition of bad states of nature. Official lending increases during wars. It increases during financial crises. It increases when geopolitical risk is elevated. And it increases during macroeconomic disasters as defined by Barrow and Urzua, which rely on big contractions in consumption. So it is strongly, whichever way you slice it, and you will get the evidence of this as we go through different episodes, it is strongly countercyclical. Okay, now, apart from the questions that I have been talking about, the paper addresses a whole bunch of other questions. Okay, I just flagged the horse race between official and private and the scale issue, but it addresses a whole series of other questions. What are the purposes? And the purposes, to tell you quite frankly, this is an area which one has to take the evidence with a grain of salt, because we also know that money is fungible and that you can make a development loan that is used for, as military assistance. You can make a development loan that the government uses as financing. So the uses part, one has to keep in mind that, but we do have evidence on the fungibility. We address a whole variety of other questions. For example, the role of central banks. It's the role of central banks, you will see, has become, it's always been there, but it's become bigger post GFC. The big question on, okay, so official lending, but official lending encompasses, it's a very big term. Who is doing the lending? And not just who, but how has this changed in the 235 years that we cover. Also, the question related to the previous one, how has it changed in 235 years? Do we have evidence that bailouts have become bigger and more frequent? So those are all questions, frequency, incidence of bailouts, scale of bailouts, and importantly, the last question that we tackle is what drives it? What are the drivers? So this is the analog of the literature that I mentioned earlier on private flows, push and pull. What are the drivers of overseas official lending? And so that's the questions that we address. This is the we've already gone through the selected key findings, and now we're into the the building blocks of the analysis. So let me just say a couple of words. I'm not going to to dwell on this, but the creditors, the official creditors, have changed pretty markedly over time. In the 19th century, up through pretty much the end of World War I, you had bilateral lending. And it was bilateral, whether it was government to government or central bank to central bank. Multilaterals, which really importantly shaped the modern landscape, start coming in with the League of Nations in 1918, and of course, the Bretton Woods institutions. So this is the evolving profile. Also, governments, even if it's bilateral, often they have set up different mechanisms for delivery, such as export credit banks, and other contributions to other regional development banks and contributions to the multilaterals. So bilaterals have offloaded direct responsibilities, if you will, to the multilaterals, to the Bretton Woods institutions and the regional development banks. Who are the debtors? Well, more than 90%. There's a few cases in which there's official lending to the private sector, but more than 90, I want to say more than 95% of the lending that we cover here is government to government or multilateral to government. We, to be able to actually provide the big picture, we had to undertake from scratch a major data gathering exercise. There's 3 databases that we use in this analysis, and I'll sketch each one. The first one is, surprise, surprise, official lending, cross-border official lending over 235. We look at loans, we look at grants, and we look at guarantees. We do not include portfolio flows, okay? So if a central bank buys a U.S. Treasury bill for its reserves, that's an official to official, but it is portfolio. It has a secondary market. So we're talking here about direct lending, whether it's through multilaterals or through governments. So you should interpret my statements about the scale of official lending as a lower bound, because our next step is to document the portfolio flows. And of course, the portfolio flows are not in the modern era have gone well beyond central banks. We now have sovereign wealth funds with very deep pockets. And that's also part of official finance. Also not included in our data are war reparation payments. But the collection process not only looks at, it looks at all the particulars that are available for that transaction. And the transaction involves obviously who the parties are, the amounts lent, the year of the agreement, and the financial terms to the extent that that is possible, meaning maturity, interest rates, grace periods, and whatever other terms if the debt is collateralized, or, for example, that's all included in this database. The data covers 1.125. Yeah.
Yeah, I think there is a problem with the slides. We are on slide 17, right?
Yeah. So, are you saying that I'm taking too long?
No, no,
Because a
no, no.
lot. Mhm, mhm.
No, because you are talking about databases, and that's why we are
Okay.
skeptical.
No. Yeah,
But
yeah,
that's
yeah,
fine. I
yeah.
mean,
No. I'm fine if I need to go faster, let me know. Uh, so
no, no.
because
Please.
this is such a data-driven analysis. And a lot of the charts I can go through more quickly because they are illustrations. But it's important to note the scale. The data involves 134 creditors and 217 debtors. It covers 235 years of lending and about $20 trillion in real terms. Is the scale of the analysis that we are covering. The second, and these are the sources. Importantly, I'm not going to go. You have the PowerPoint, so you can look this up. But importantly, there are a lot of very difficult to get and opaque data sources that involve treaties in the 19th century. So this is a fairly extensive process. And declassified CIA documents and historical budget accounts and so on. The second database is debt stocks. So we have flows, we have stocks. The debt that this is the first in my work with Ken Rogoff on This Time is Different. Our focus was on total government debt, dividing it up into domestic and external. And external was not decomposed into private and official. This is what we're doing here. Our focus is we're the first to actually provide an extensive database that decomposes the external debt stock by creditors. Obviously, for a subset of these
Carmen?
countries, yeah.
Yeah, I just have one question. The database. So, how do you assess the quality of the data, especially for the old data?
It's the um, flow data is quite good actually, subject to one caveat. These are commitments. So these are treaties. A lot of the lending in the 19th century. You didn't have the multilaterals. You had, most of the lending is by major powers. And The caveat is we don't actually have a track record of the amounts disbursed, okay? And we state this very clearly. These are commitments, but they're commitments, we have the legal documents we consult. That's why we have a 100-page appendix of which you not only do cross checks, okay? So the one caveat is not really about quality. It is, to the extent that the amounts disbursed follow the commitments. However, on your question on quality, there's the issue, and we say this very much up front. We know this is not the universe, because the big powers during the last 200 years, which I will list them, but you can pretty much guess. UK, US are dominant in there, but we also have other European and so on, are comparatively more transparent. There is much more opaque lending, okay? And that, so to answer your question, if anything, what we are showing here are lower bounds of the cross-border lending. In recent work, that Sebastian Horn, Christoph Trebisch, and I have done, for example, on Chinese lending. Chinese lending is very opaque. And, we've built up these databases. I'm not going to go into detail here, but that is also embedded in here. So we tried to tackle cases where the lending was opaque, and that's also very important to rely on countries, on databases like the CIA. The CIA during the Cold War was precisely doing the best it could to track lending from Russia, from the Soviet Union, from China, and so on. You will see examples of that. So subject to the caveat of, the number one caveat is that this is a lower bound on the scale of official lending, and number two, that we have commitments on the treaties and policies as opposed to the actual path of the disbursement. The last database is, and then now I'll pick up steam, very granular data on public and private capital flows during periods of crises and wars. Okay. And you will see many illustrations of this database in the analytical part. So great powers, this is the list of great powers. These are great powers wars. This is sort of, that was sort of the last definition. We will see crises in the crisis episodes that involve the great powers. We will see wars that involve the great powers. We have all kinds of disaggregation that we will go through. Now, just a big takeaway on this figure. This is purposes of official lending. As I said, money is fungible. But in a nutshell, what you see in this chart is that the dominant cross-border lending of the 19th century, up until really the creation of the Bretton Woods institution, the dominant cross-border lending was for wars. was to your allies. There is crisis lending. We will see central banks to central banks. But, the more generic development assistance, bailout programs for developing countries and so on, this is of modern vintage. And central banks.
Carmen?
Yeah.
Carmen?
Yeah.
Yes, we have a question in the chat. So the question is from Hagai Etkes. Did you consult official lending strategies of large lenders? For instance, the IMF has officially strategy for fragile and conflict-affected countries. Can they point on structural changes in lending to war-affected countries?
Could you just repeat the very last part of the question, please?
Can they point on structural changes in lending to war-affected countries?
IMF lending, IMF cannot. I say this because a lot of the, some of the countries in wars, there's countries in wars that have capital market access and so on. The IMF, the purpose of IMF lending is balance of payments, and dealing with financial crises. So, they directly, they would not lend to a country that has a war if there is no balance of payments or financial crisis. If there is an economic problem and it's in war, it depends on the scale of the economic problem. The IMF and the World Bank can't lend to a country in default unless it's negotiating with its creditors. The lending during wars, even to countries in default, is typically it is not typically, it is a bilateral. It comes from bilateral, through bilateral lending, government to government. Does that address the question? I want to just make sure that was the nature of the question.
I think so for the moment, yes.
Okay.
But
so the key takeaway from this is central banks, central bank to central bank lending is not new. I mean, you can see this already, going back to the crises of the mid 1820s, but its scale is much smaller, as you see, than the lending of during war, but its relative importance has increased significantly. We see this in three things: the global financial crisis, the COVID pandemic, and the rise in China's PBOC swap lines. Those, all three combined, bring you to the modern era where official lending by central banks has become a bigger actor than it was previously. This here, this chart looks at the incidence of official lending, conditional and unconditional. So these are conditional and unconditional probabilities. The incidence of official lending, conditional and unconditional probabilities. The unconditional probability of getting a loan in the loan 19th century was extremely low. It was around 2%. The unconditional probability, this is no crisis, no war, the unconditional probability of getting a loan in the modern era is over 80%. So just the incidence of official lending has increased over time. The incidence. And we will see that, then we compare the unconditional probabilities of getting a loan to the conditional probabilities of getting a loan conditioned on having a financial crisis, a debt crisis, or the probability of getting a loan conditioned on being at war. And, the conditional probabilities increase by even more over time. So the odds of getting a rescue loan during a crisis, have multiplied by a factor of 10. And also war financing. So the incidence of getting official lending is much higher than it was. Now, what about the magnitudes? And that I'm going to speak to next. And the magnitudes are, the incidence of a bailout are higher. So is the amount of the bailouts. If what this table shows here is that the average bailout size, we've scaled it relative to imports here rather than GDP because, the trade data is far more reliable for the kind of very broad country coverage that we have. So this is, note this is the scale of the loan relative to imports. But the average bailout size has about doubled. So the incidence of the odds of getting a bailout has increased tenfold, and the amount of the bailouts have doubled. So definitely, this is in the direction of a much more actively interventionist official state when it comes to cross-border lending than it was in the 19th century. Again, 19th century was just primarily wars. Now, who lends? I'm going to switch, so these are all aggregate findings. And I've anticipated this chart by the earlier charts, in which you really see that in the long history, bilateral creditors were really dominant. If you were to extend this chart back to 1790, you see that bilateral creditors were it. Multilaterals, really, the first of the multilaterals comes around 1918 with the League of Nations, but it doesn't really take off until the 60s, 70s, 80s with the growth of the Bretton Woods institutions, the IMF and the World Bank. And here is the more granular country of origin. Lending typically connects to the great powers, whoever the great powers of the time are. You see the UK after World War I, the UK, and again, if you extend this further back, the role of the UK in the 19th century was dominant. And importantly, this is what I alluded to earlier, in the modern era, the big growth, the big new powerhouse in cross-border lending is China. Now, let me just say something here. It's 1 second aside or 2 seconds aside. People, when, people ask me about, is the dollar on its way out? And one of the things they said, well, what about the growth of China's overseas lending? Let me know, China's overseas lending, more than 2/3 of it, actually close to 3/4, is in dollars. So that's, not part of this inquiry, but let me shift gears now. So we've talked about, who lends, what type of lending, has the profile of lending taken off in terms of incidence and in terms of scale. But now what we're going to do is a comparison of what happens with private and official flows during wars and during economic crisis, defined as someone having a debt crisis. Okay, what you're going to see is going to be repetitive, not because we like being boring, but because it's what comes out. The same pattern. We start with World War Zero, which is really the Napoleonic Wars. It's the extent of and scale of the war classifies it as a world war of its time. And what you see is the red line tracing private capital flows. This database comes from the work of Reinhart, and Trebish, in which we several years ago put together a long-dated database on private capital flows. And then the bars are official flows. So, what we see is a surge in bilateral lending. And this is the UK making loans to countries that were fighting Napoleon on various fronts. The pattern that you see for the World War I and World War II is the same. The red line, basically, you see the collapse ahead of World War I of private capital flows. And let me clarify this. It's, in the modern era, we have risk on, risk off. Okay? This is big time risk off. However, risk off is not the only driver. When there is in these, global war episodes, what you see is across the board the introduction of capital controls. So even if capital flows, private capital flows wanted, even if the private sector was willing to lend cross-border, to its activity was hampered by capital controls. But even absent capital controls, even in cases where you have wars without capital controls, you typically see a tapering in private capital flows. However, as you see, these are the twin peaks in official lending. After World War I, you get a recovery in private capital flows. You see the little, it's not a boom, it's a boomlet. That surge, that's not a surge, but it's a recovery in private capital flows. And this is the transition from the UK to the US. So the big issuance in the roaring 20s of bonds is centered in New York, no longer London. But even that, as I note in the little footnote, in the little note, it's a boomlet rather than a boom, because by 26, international commodity prices are crashing. Florida real estate market is crashing in the U.S. And you have, and ultimately, of course, you'll get the crash in the equity market and so on. You start seeing the onset of the Great Depression. But the takeaway, of course, is official lending surges during wars. And here is an aggregate. Here, what we did is I've shown you three individual cases of war. And World War Zero, Napoleonic, World War One, World War Two. Here's an aggregate of 9 great powers wars. Those are in the notes, and I had introduced them earlier. And you see the same pattern. Private cross-border lending diminishes into the war. And this is here without uniformity of capital controls, okay? Not all these wars, I mean, some of them, as noted earlier, during the First and Second World Wars, but not all of these wars involved cross-border capital controls, and you still see a contraction in private flows. I thought it would be of interest also to highlight just the granularity of our data. So to do a case study, so here is the Yom Kippur War of 1973, and this is official lending to Israel, and this is primarily from the U.S. And you see the official lending to Syria. This is primarily from the Soviet Union and its satellites. I don't include here in these two charts private flows, but the point of emphasis here and here is that official lending to both sides from different lenders surges in wartime. This is the kind of document that this is a declassified CIA document that tracks what the lending to Syria was during the Yom Kippur War and its immediate antecedents and aftermath. So this is just, it gives you, I think, a granular flavor for what we have for each episode when we talk, when we aggregate across wars and so on. But this is what we have among those. I mentioned that we have 1.25 million transactions included in the database. This is, on the U.S. side, the announcement of the support for Israel. And remember, in the very last excerpt,
can you show us the slide on the Yom Kippur War?
This is a case study. Here's the example of primarily U.S. lending and the surge in overseas borrowing Israel from the U.S. This is a typical pattern. And here is Syrian lending from the Soviet Union and Soviet satellites. And here are the sources. This is a CIA declassified document, as I mentioned. We have built this is a very important, way to illustrate using this case study what our database includes granularly. This is U.S. law here. When so you have, and you asked this earlier about the quality of the data. We're pretty confident, on these amounts. Obviously, if the CIA wasn't privy to further lending, because that lending was indeed very opaque, okay, then our estimates are, our data is going to be, which is based on their figures, is going to reflect the same problem. But I don't think that obviously on the U.S. side, it's all through the budget and so on, so that there's no real issues there. But in some cases, notably, whether we're talking about the former Soviet Union or China, or the opacity issue raises the issue of data qualities. Now, I hope I have convinced you, looking at the various across time, aggregated, disaggregated case studies, combined, that official lending rises significantly during wars, whereas private lending recedes. You're going to see the same pattern now when we turn to financial crises. What episodes do we look at? All right. We look at episodes which we can consider a global crisis, meaning, at least one financial center is affected. In that episode, at least there is one default. By the way, debt statistics for the lower income countries. They don't do this for the higher income countries, none of the advanced economies, none of the high income countries, but they do it for the lower income. They do have the distinction by creditor. They, whether sovereign borrower, but private creditors, whether it's commercial banks or a bond, and official creditors. Okay, all right. So now we're looking, and it's going to be repetitive, the same pattern that you saw of the surge in lending, which is why we're very confident that one of the big results on the different dynamic between private flows and official flows is something very robust. In bad times, you see official lending go up, at the same time private flows scale back. This is the Asian crisis. You may wonder, why is this included in a global? Well, the criteria that we use, which is spelled out, please, just eyeball at least parts of the appendix also, in which we detail everything.
Okay.
But very quickly, why is this? Well, it involves, 5 Asian economies, less so the Philippines, Thailand, Malaysia, Indonesia, Korea. But it also, that's 97, 98. In 98, in August, we had the default of Russia. The default of Russia and Ukraine also tips over long-term capital management. You have the failure of LTCM. You have big turbulence in U.S. capital markets. In effect, the Fed engages in an interim easing to calm markets. European variable rate mortgages are spiking during, so it was a period of turbulence that was not, despite the name of Asian financial crisis, was much more pervasive. This is detailed, and this, okay, here's the Eurozone crisis, in which the largest IMF programs are to Greece, Ireland, Portugal, and of course, a lot of financing from the European community through various agencies. This is also global debt crises, all of them aggregated, sort of the analog of what we saw for the wars, and again, repetitive. I mentioned that another important difference between private and official lending was the terms of lending. And what this here shows is the red line is the interest rate on sovereign bonds that were issued and payable to the private sector. So these are sovereign bonds, overseas, bonds that are held by private creditors. That's the red line. The blue line is the interest rate on the official loans that we have cataloged in this. Importantly, also, the official lending has much longer maturity. The United Kingdom only finished repaying its World War II debt to the U.S. in 2006. So, very long maturities, very favorable terms, whether we're talking about a developing country or an advanced economy. And this is the risk return correlations that we see. We have, credit ratings. This is all detailed in the appendix. Credit ratings are in the horizontal scale. Interest rates on the loans or bonds are on the vertical scale. As expected, you have higher risk merits higher return. It requires having higher returns. So you see that in the private side. You don't see that in the official side. And finally, this is our last endeavor in this analysis, is what drives the geography of lending. Why, what are the drivers of official finance? And these are bilateral official flows, and this is going to be our dependent variable. And what are we going to test? We're going to test two very evident, self-explanatory hypotheses. One is that in terms of these observed increases in official lending that we see during crises, countries choose to lend to countries that are importantly connected economically, either through trade, finance, or both. In other words, you help them because you want to also help the residents in your country that are connected. Namely, if banks have made loans to these countries, the banks would be affected. So the motivation for a bailout is a benign self-interest. In times of war, the natural, obvious is you lend to your along alliances. So they're pretty self-evident hypotheses. What we do is a standard augmented PPML gravity model. We do all kinds of sensitivity analyses. The dependent variable are, the loans, the bilateral loans. The regressors are pairwise dyadic measures of economic exposure. We use trade because in what we report, we use trade because it has a cleaner, longer time series. We also do this for cross-border lending in terms of BIS data, commercial lending, and we have two different kinds of financial exposure, but unfortunately, they would really cut the sample much shorter. So the bigger, longer dated one is trade. We use political alliances. We use cultural links. The one we report here is common language, but we also look at, religion. We look at former colony, and finally geographic distance. We do, the standard set of controls, and the results are, we have pretty robust, more robust in some periods than others, results along the lines of our priors. Okay, so let's start with the crisis and then move on to wars. The effects of, so if you look at the overall, we report here full sample, pre-World War II, post-World War II. And then the last two sets of regressions, we include interaction terms. The interaction terms support the hypotheses that I already outlined of benign self-interest in the lending during crises and alliances in the lending during wars. One note of interest in these results is that, and the magnitudes are big. Okay, so I'm rushing now because I want to get through, but the magnitudes of the increases in estimated lending are not just statistically significant, but big. However, the fit for wars diminishes substantially post World War II because you don't have the large variations. You don't have the big spikes of World War I, World War II. This is all, described in detail, and you have this in front of you. I hope you can see. We're on slide 44. In times of debt crises, we see the flip side of that, namely the linkages have become stronger post World War II. The impact of a crisis on cross-border lending is bigger. And you see this in the breakdown over time, the pre-World War II, post-World War II, the effects of our estimates of trade linkages. And also, we get the same results when we do the BIS data, cross-border banking linkages, is stronger in the more recent period. So, to conclude, I think we need to think that here is a pillar. Official finance is a pillar of our global financial architecture. And when you look at the models, where is it, right? The standard frameworks, the models in which we look at risk sharing, we look at sovereign borrowing and sovereign default. These models are all usually about private lending. So we really, this is, I think, a fruitful area for what is filling in a big gap. The agenda for us, I've already alluded to this, and I'll conclude here that for not just the reasons of, the fact that we, as much as we try, we don't cover the universe of official lending. We feel that what we have here is a lower bound. We are going to continue to fill in gaps and move in the direction also of working on the very opaque portfolio flows. And why do I say opaque? Well, there's less opacity when we're talking about central banks, but when we're talking about sovereign wealth funds, which have very deep pockets, the large UAE, Saudi, Chinese, these are very deep pockets, a lot of official finance going on there. That is an area that remains, it's a big issue, plays a big role in global finance, but remains unquantified, and that's what we're moving next. And I'll stop here.
Thank you very much. It was a very deep and rich presentation. We have a question from Evangelos Stravelas.
Yeah, hi. I hope you can hear me.
Yes, I can hear you.
Okay, hi. Hi,
Hi.
Carmen. Excellent presentation. I was expected. I just listened to you, and I have read the paper, I must say. You have an extensive data set that covers almost 30 centuries or so, and it covers the spanning, the birth and collapse of and the reconstruction of the international monetary system itself. You have the Bretton Woods architecture, the gold standard, the post 1971 flows, etc. I mean, each regime has defines fundamentally different constraints on what official lending can do and at what cost. I mean, the question comes up to me: is the counter-cyclicality finance stable across these monetary regimes, or is it an artifact of the specific era where official flows faced non-competitive reserve assets and no credible private alternative? Let me put it differently. In conclusion, came up: is official finance a structural pillar of the international system, or a pillar of the particular monetary order that may not survive the next regime's transition?
It's a great question. It's a great question. Okay. It's something somewhat beyond what we cover in our, but the answer to your question is, we don't tackle that explicitly, but let me say where my gut on. So, you heard me in the presentation say many times, look, the incidence of official lending has increased over time. The magnitudes of official lending has increased over time. And you're asking me a very important question, which is, is this official lending and its modalities also, a function of the changing nature of the financial architecture or financial, monetary system, for lack of a better term? Let me say this. I think since the creation of fiat money, fiat money makes it easier to lend domestically and internationally. I think that is, but I don't know if exactly that's what you had in mind, but during the gold standard era, during the pre-fiat money era, as I said, lending was much less frequent. It was still the only game in town in wars. And you saw, in financial crisis, central banks lending to central bank lending. Obviously, you had no development assistance. And even during disasters, it was not infrequent to see absolutely no international response to natural disasters either. So, is the increase in lending, the cross-border lending, that somehow we become more altruistic? I don't think so. I think also that the ability to lend, that the shift to fiat money has loosened, the loosened finance. You have a greater role and part of that shows up in a big increase in the importance of global official, cross-border official finance. But that's a conjecture at this stage. We haven't tested this, but it's pretty evident. It's a.
Okay, thank you very much. Sanjay, can you connect to ask your question?
Yes, please.
Okay. Yes.
Professor Reinhart, in the context of the recent US-Israel-Iran conflict and the growing role of China as a leading official creditor, do you see a shift toward a new world order where financial lending and geopolitical influence are increasingly intertwined, potentially redefining traditional Western dominance in global finance?
So what I would argue is that that our results indicate that, lending by the major powers of the time, right? Whether we're talking about the UK in a prior century, has always, especially when it comes to war, has always been very driven by alliances and geopolitical factors. I don't think that's new at all. That's in effect supported, when we look at our gravity model, it's pretty clear. And also when we look at self-interest, that's also pretty clear. And let me give you very quick 3 examples in which the US, Europe, and China kind of doing the same thing. The European bailout of Greece, well, one can argue, was it Greece it was being bailed out, or French and German banks, right? This is the kind of what we pick up in the gravity model as well, with self-interest. That's, the US, the bailout of Mexico during the 1994-1995 crisis. Bondholders in the U.S. were up to their ears in Mexican bonds. Also, of course, there was the cross-border fear of surge in immigration. So again, self-interest. China, PBOC is now extending swap lines that are really theoretically swap lines, but in reality they get rolled over, so their maturity is closer to like 4 years. So this is long-term lending, okay? But it's done through the PBOC swap lines. And who are they lending to? Surprise. They're lending to the countries that have difficulties, that are, have signs of distress, whether financial debt distress or a combination of the two. But the countries that they have their development banks have made a lot of loans to. So they're helping their own banks. So what I'm saying is, these are very different agents, but they're both in terms of the importance of geopolitics in who do, the tensions with the U.S. and China. We had decades of tension with the U.S. and the Soviet Union as well, and I think the self-interest part, whether in wars it's alignment or in peacetime it's economic, exposure and benign self-interest is I think what I'm getting is some of these factors go deeper than the individual power configuration of the day. They cut across different great powers over time, different creditors and debtors over time.
Okay, thank you very much. Thank you very much.
Thank you very much. So now we have a question from Nikita Kotsanko.
Yes, hi. Thank you so much for your presentation. My name is Nikita Kotsenko from Bank of Israel. I have some concerns about the regression analysis in terms of the handling time trends. So in particular, not scaling the GDP, the flows to some sort of GDP, which changed drastically over this time period, and also spurious correlation concerns due to time trends.
Okay.
How do you handle those?
So that's a very important point. And the thing is, I always hate doing this because, after the fact, and I didn't mention that, in all the figures I showed, in all the analysis we do, the nominal magnitudes are scaled by, we did a variety of things. I'll tell you the baseline one, the one we use. We scale everything, by the financial center of the time. So from 1790 to World War I, everything is divided by UK GDP. And post-war, it's US GDP. So it's scaled. So the
regression as well?
Yes.
Yes. Sorry. So I didn't understand this from the slide.
No, because I didn't say it. I mean, it's you're absolutely, and I didn't say it, and I showed all the graphs, and I showed all and I never mentioned this, but it's there. So it's UK GDP through World War I and post World War I is US. We also tried scaling it by estimates of world GDP, but the world GDP series, like, it just, I think it introduced more measurement error than benefits, whereas UK and US GDP are pretty scrutinized. We also, did units of measurement in terms of exposure. These are shares. So the trend line issue, I think that primarily would be, of course, huge. This is how we address it.
Sorry, I didn't understand how you address the trend line issue. Is there a trend line?
No. What I'm saying, the trend line that you would have if you use nominal magnitudes without scaling.
Oh, yeah.
That which
right.
would be huge. Yeah.
But we shouldn't be concerned about non-stationarity in the regression?
Look, a high level of persistence is very difficult. We know this, that from all the work of Passaran and others, that persistence is often very difficult to distinguish from a unit root. It's difficult to see, how you would not have mean reversion in the variables as measured. I am, frankly, more concerned, for example, in the context of the regressions, about omitted variables. Let me give you a concrete example. Than I am about the issue of stationarity. I think, we beyond alliances, military alliances, having, another measure of proximity, geopolitically, sort of a broader definition of alliance, I think would be very important. So I think, if you ask me what I think would improve the regressions is having a better measure of geopolitical closeness than what we use. Okay.
On this point, have you considered the bilateral migration flows?
No, we have not. We have not. But let me say this, and I'm not raining on your parade on that one, because the measures we have really for the modern period, the really great fit, if you look at also financial linkages, the BIS data, the financial data, the interconnectedness of banks. But what happens is we lose so much of the sample because of, and I think migration flows, probably much better than the financial variables in terms of coverage, but still not quite matching trade. I don't think anything matches you see what I'm saying? There's a trade-off between. Yeah, that's the.
Okay, thank you very much.
Thank you very much, Carmen, for this deep reply. And now we have a question from Payas Gokal.
Hello, I'm audible?
Yes.
Thanks a lot, Professor Reinhart, for your brilliant presentation. My question was again about the model. I was wondering, so in your gravity model, while you have incorporated the geographical reasons and the geopolitical factors that can affect the official loans, do you think there could be any purely economic or financial factors, let's say interest rates or exchange rates, which could determine these loans?
What do you have in mind? No, tell me, what do you have in mind?
So I was wondering the factors that tend to determine the private capital flows.
Right. That's what I thought you were going. That's a wonderful point. So, to grossly over summarize the literature, you have a set of time trusted external variables, interest rates, global interest rates, the work of Helene Ray, also my own work on interest rates with Guillermo Calvo and Leo Lederman a very, very long time ago. But, the financial cycle, the VIX, and international commodity prices. Now, the truthful answer to your question is, did we try these variables as drivers? The answer to that is not for the whole sample. We actually spent a lot of time doing that when we were doing China's overseas lending. Okay, we spent time saying, did China lend more when interest rates were low? Global interest, the answer is no. Did it lend more when commodity prices was high? Yes. So what you're saying is basically a very good idea, that just for the sake of completeness, we should include as regressors some of the same factors. However, okay, bear in mind the two pictures, well, particularly the second picture that I showed earlier, that showed that sovereign lending isn't connected to the private risk return trade-off, right? That, this is, part of the risk return trade-off on private lending. Your risk on, risk off involves, of course, importantly, not just individual country risk, but also global interest rates. The correlation between risk and return, risk and interest rate charge on the official side is actually slightly negative and significant. Now, I'm not going to, because I want to see if there's another question, but I'm not going to deny that I think it's still a wonderful idea to try some of those variables, just to say, okay, these are the variables that are classically included as regressors in private flows. Why don't we see what they look like in official flows? But my suspicion is when it comes to interest rates, I have no idea on commodity prices, but when it comes to interest rates, that it's not gonna. It's not going to be a driver, because, look at all the pictures I showed you. When in bad states of nature, official lending surges. In bad states of nature, interest rates in these countries rise. But anyway, point taken.
Thank you so much. That is very interesting.
Thank you very much, all, for your participation and questions. So we are completely out of time, but it was so interesting. So thank you very much, Carmen, again, for this excellent presentation. I have additional questions. I will ask them by email. It was a great pleasure to have you here, and we really hope to have you again. Carmen, thank you very much.
You're quite welcome. It was a pleasure, and we could, I'm sure, go on.
Thank you. Have a nice day.
Bye. You too.
Bye-bye.
Bye.